Most farmers do the exact same thing after they sign their loan documents. They breathe a sigh of relief, file the paperwork away, and get back to the real work of running the farm. It makes perfect sense, but that one simple act could be quietly costing them tens of thousands of dollars a year. The common belief is that if you've got a good deal on your loan, it stays a good deal. And the truth is, a loan that was competitive 5 years ago is almost certainly a financial handbrake on your business today. The market changes, banks' policies shift, and what was once a great deal is now silently draining your profit. After reviewing hundreds of farm loans, I see this same pattern over and over again. So in this video, I'm breaking down the 8 most common and costly mistakes that stem from this set and forget mentality. And I'll show you how to spot and fix them to save thousands and unlock future growth. Welcome to Dollars in the Dirt. I'm Brecken Curtis, and this is where we break down the finance side of farming so you can grow your operation, buy that next property, and build real wealth. Let's get into it. Number 1 is focusing only on the interest rate. We've talked about this before. The cheapest rate is not always the best loan. The true cost of a loan includes all the other fees: your line fee, unused limit fee, establishment fees, valuation costs. 2 loans might look identical on the rate sheet, but once you factor in all the fees, one could cost you thousands more each year. So the tactical step here is to always look at the total cost of credit, not just the headline rate. You need to do the maths and figure out what you're really paying. A good broker can help you with this, but it's something you need to be aware of. Don't fall for the bank's marketing tricks. The next mistake is a big one, and it's about leaving yourself enough room to move. Agriculture is a volatile industry. You have to deal with weather, fluctuating commodity prices, rising input costs, and that's why it's so dangerous to borrow right up to your absolute limit. Many farmers structure their loans with no buffer, and when a bad season hits or prices drop, the pressure comes on very quickly. Good seasons can make borrowing feel more comfortable, but your loans need to be able to survive the bad seasons too. So the tactical step is to always build in a buffer into your borrowing. Don't max out your LVR. Leave some equity in your property as a safety net. It might mean you can't borrow as much as you'd like to in the short term, but it'll give you the resilience to ride out the tough times and be in a position to expand when good times return. Number 3, not structuring loans around farm cash flow. And this is a classic mistake. The bank sets up your farm loan with a monthly repayment, just like a residential home loan. But your farm income isn't monthly, it's seasonal. You might get paid once or twice a year. A rigid monthly repayment schedule can put a huge strain on your cash flow and force you to sell livestock or grain at the wrong time just to make a payment. Your finance should follow the rhythm of your farm, not the bank's standard template. And there's a better option available. You can negotiate for seasonal repayments that line up with your income. You can build an interest-only period to get you through the off-season, and you can have flexible redraw facilities that let you access funds when you need them. The tactical step is to demand a loan structure that works for your business and not just for your bank's system. Number 4 is not reviewing your loans regularly. Set and forget is a recipe for disaster in farm finance. I see so many producers who might have been with the same bank on the same loan structure for 10 or 20 years. But the market is constantly changing. Interest rates move, lending policies change, and the property value increases. A loan that was competitive 10 years ago is almost certainly not competitive today. A quick loan review every couple of years can save you tens of thousands of dollars over the life of the loan. And it can help you reduce your interest rate, improve your loan structure, and increase your flexibility. So the tactical step is to diarise a loan review every 2 years. Sit down with your broker, look at what the market is doing, and see if there's a better deal out there. Loyalty to a bank that isn't looking after you is a very expensive mistake. And that comes to number 5, the overcomplicating loan structures. Just quickly, if you're tired of explaining your operation to a new bank manager every year, only to get a one-size-fits-all deal that doesn't fit your business, we can help. At Seasoned Finance, we do things differently. We've got over 70 years of combined experience in agricultural lending, and we work for you, not the banks. We're the consistent expert team in your corner, fighting to get the finance that actually helps you grow, purchase the next property, and build your legacy. Don't leave money on the table. If you're looking at your next move or just want a second opinion on your current setup, click the link in the show notes to book a confidential, no obligation chat with the team, and we'll show you what's possible. Righto guys, now back to the episode. Now on the flip side of a lazy, unstructured loan is a loan that is structured too complicated. I've seen businesses with multiple different loans across different banks for different parts of their operation, and it becomes an administrative nightmare. You're paying multiple sets of fees, you're trying to keep track of your multiple repayment schedules, and you lose all clarity on your total debt position. Simplicity is often better. The best approach is to have a clear, simple loan structure that is aligned with the different parts of your business. A core debt facility for your property, a working capital facility for your operations, and a separate facility for your machinery. Finance should support the business, not become another management burden. So the tactical step is to consolidate and simplify your loans where possible. Get everything under one roof with a clear structure you can easily manage. Number 6 is not understanding all the fees. We've touched on this before, but it's so important it deserves its own point. Fees can quietly add up and cost you a fortune. The most common fees that farmers overlook are line fees, unused limit fees, annual facility fees, fees for valuation updates, early repayment penalties. A line fee of 0.25% on a $3 million facility is $7,500 every single year, regardless of how much of the loan you're using. And that's a lot of money. So the tactical step is to get a full list of the fees associated with your loan and to do the maths. Understand what you're paying for, and if you're not using a particular feature, ask for the bank to remove it. Don't pay for things you don't need. Number 7, fixing your loans without understanding the trade-off. Fixing your interest rate can be a smart move, especially in a rising rate environment. It gives you certainty over your repayments, but it also comes with a significant trade-off. The main one is the lack of flexibility. If you fix your loan and then you need to sell a property or refinance, you can be hit with a massive break cost. I've seen break costs in the hundreds of thousands of dollars. Fixed rates also often have restrictions on your ability to make extra repayments. So before you fix your loan, you need to ask yourself a critical question. Does my business need flexibility over the next few years? Am I likely to sell assets? Do I want to be able to pay down debt faster if I have a good year? A fixed rate might look attractive today, but it can be a very expensive trap if your circumstances change. The tactical step is to weigh up the certainty of a fixed rate against the needs for flexibility in your business. Number 8, not planning for growth. And the final mistake is not structuring your loans with the future growth in mind. Most farmers want to expand their business at some point, whether it's buying the neighbour's block, leasing more country, or investing in new infrastructure. But if your current loans are structured poorly, it can make it much harder to borrow more money in the future. For example, if you already have a maximum LVR, or if your loan structure is messy and unprofessional, the bank will be hesitant to lend you more. So the tactical step is to always structure your finance with the next opportunity in mind. Keep your LVR at a sensible level, keep your paperwork clean and professional, and have a clear plan for where you want your business to go. Your finance should be a tool that enables growth, not a handbrake that holds you back. So there you have it. The 8 most common mistakes farmers make with their property loans. Finance should be the tool that strengthens your farm business. The best property loans aren't just about borrowing money, they're about creating flexibility, resilience, and long-term growth. Take a look at your own loan today. Are you making any of these mistakes? And if you are, it's time to do something about it. A good broker can help you review your structure, identify the problems, and negotiate a better deal with the bank. It's one of the easiest ways to improve your bottom line and set your business up for a stronger future. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Season Finance via the link in the show notes. Remember to follow us on socials and catch you next time.